Yeah, let's maybe in the interest of time move on and talk a little bit about Chinese outward FDI. So the reason we're looking at that here is because it's one of the factors that played into our into the assumptions that we put into our baseline forecast as to how much different countries would be exposed to the risk of higher tariffs. One factor is the one that Steve spoke to at the top, right? If you run a large trade surplus vis-a-vis the US, then there's a higher chance you'll be slapped with tariffs. Another factor is economic integration with China. So this chart here shows you Chinese outward FDI. So it shows you the stock of outward FDI across the top 10 economies. And we see a lot of Southeast Asian economies here, right? Places like Indonesia, Vietnam, Malaysia, and Thailand. There are also high-income economies here, but those are usually several times larger than the economies in Southeast Asia. So just in relative terms, China's footprint in Southeast Asia is pretty sizable. So why does it matter? Well, it might matter because it contributes to the perception that Chinese firms might evade tariffs by tariffs on exports originating in China by rerouting them through other locations in Southeast Asia. So that puts these economies in the crosshairs. We've talked a lot about why that applies in the case of Vietnam, and that's certainly one of the economies that would be high up on the list. It's perhaps the economy that's benefited the most from the changes in global trade patterns seen since the first trade war, and it will be in the crosshairs for that reason this time around as well. At the very least, there will be greater scrutiny on the sort of shipments that traverse Southeast Asia. Before I hand it over to Harry and we move on to the next slide, Harry, is there anything you think we should add here?
No, I think that's perfect. I think we might move on to a bit of a discussion on China, just in
All
the
right.
interest of time. Thank you for that. Look, obviously, we've mentioned a few times here, China is clearly in President Trump's sights. Already, he's announced plans for a 10% hike in tariffs on goods coming from China. And as Steve mentioned earlier, that's set to get much higher in the future. What does that mean for China's economy? Well, tariffs impact the economy in lots of different ways. And that's what I want to run through today is how some of these channels of impact will flow through China's economy. The first and the main channel of impact is obviously through exports. So tariffs increase the cost of Chinese exports to the US. It makes them less competitive. And then because of that, the volume of exports going to the US from China will be lower. We saw that in 2018 and 2019 when those tariffs first started going up. Look, put simply, when things become more expensive to buy from China, US firms and families, they're going to look to other locations to source what they need. Hopefully they can find it. If they can't, well, some of them are going to cut back on those purchases altogether. But either way, we're going to see exports from China to the US move lower. This chart, it shows that impact. So it compares our latest forecast that incorporates Trump's election and the tariff profile that Steve showed earlier, and it compares it with our pre-election forecast. So anything that's above the line shows exports being a larger contributor to the economy than they would have been. Anything below that line shows when exports are making the economy smaller. As you can see, tariffs, they pull Chinese exports lower, and in turn, China's economy is going to be smaller than it otherwise would be. At its peak in 2026, those weaker exports are going to shave around 1% off China's economy. Now, the observant amongst you may notice the period at the start where exports are actually a little bit higher than they otherwise would be. We've had a few questions come through on this already. That's the period that we're in at the moment. It's the period from when tariffs have been announced, or at least they've been threatened, compared to when they actually take effect. So that gap creates a bit of a window for US firms to bring forward orders to try to get in ahead of those higher costs. That's exactly what we've seen already. So Chinese exports rocketed at the back end of last year, and we actually saw that exports to the US grew at their fastest pace in around 2.5 years through the September quarter. Obviously, though, that's a very short-lived phenomenon. It's happening now, but when tariffs do start to take effect, we'll see exports move lower. As I said, tariffs, they impact the economy in lots of different ways, and certainly through more channels than just exports. One of the other key channels for how President Trump's election will impact China's economy is through weaker investment, which is set to pull Chinese GDP growth lower as well. And you can see that in the green bars here. There's a few reasons that investment's going to be lower. For starters, with exports lower, the available market for Chinese firms to sell to is going to be smaller, or it's more constrained. And that means there's less need for Chinese firms to expand operations. If people are buying less, you certainly don't need to invest in new machinery or manufacturing plants to produce more. Because of that, investment by Chinese firms will be lower. Tariffs also create a massive amount of uncertainty. So firms are asking themselves questions like, how high will tariffs go? How long will they last? Will there be more? All of these things are running through firms' mind. That uncertainty is absolute kryptonite for investment, and that pulls down investment further. With businesses doing poorly, then employment and wages are also set to be lower than they otherwise would be. That will hit the already fragile household consumption at the moment, and we can see that as a detraction here in pink. Now, governments, they won't sit idly by. We do expect both local and central governments to offer some support. And in fact, already local governments have been instructed by the central government to bring forward some of the spending to the start of this year. The central government, they've also foreshadowed about a 1 percentage point increase to the budget deficit ratio this year. So the central government, they impose a limit each year on the country's deficit, generally around 3% of GDP. We think it'll hit around 4% this year, and that frees up a whole lot more government spending to support the economy. The fruits of that spending, well, that is shown here in teal, and that'll help to offset some of the pain from weaker exports, weaker investment, and the hit to household consumption. Finally, imports are also set to be a little bit lower. That's for a few reasons. If you're exporting less, then you need to import less materials and inputs that go into what you're manufacturing. Lower investment also means that there's less need to import things like machinery and equipment. And finally, with household consumption lower, imports of consumption goods will be lower as well. It may be a little bit counterintuitive here of how that looks on the chart, but the way that we think about GDP is trying to calculate the production that occurs within a country's borders. Because imports is production that's occurring somewhere else, it shows up as a bit of a positive contribution to growth here. If we sum up all of those drivers, we get the total impact of tariffs on China's economy. That's shown by the black line here at its peak. So around the first quarter of 2026, the economy is on track to be almost around 1% smaller than it otherwise would be. And if you think about that in growth terms, as Steve spoke about earlier, we expect the economy to grow around 4.3% this year. That's down from 5% last year. And by comparison, without any tariffs, we had expected the economy to grow around 4.7%. For next year, the economy will slow even further, down to around 3.9%. And that's from our previous forecast, our non-tariff forecast of 4.2%. So those are the headline impacts, but there's plenty happening under the hood as well. Two of the big consequences of tariffs, and I suppose a slowing Chinese economy more broadly, will be higher unemployment. Already the labour market in China is very, very shaky. If you look at some of the measures of job security, they're near record lows. And perhaps probably the most worrying aspect of that is the extremely elevated levels of youth unemployment. There are so many graduates leaving university each year that are unable to find work. With an economy that's smaller because of tariffs, that means even fewer job opportunities for those graduates and generally potential workers, and that'll push unemployment to around 5.5% by the middle of next year. That's up from 5% today. You'll see that in the left-hand side chart. Foreign investment into China also set to take a hit. That's the right-hand side chart. The weakness in China's economy over the last couple of years has already kind of flicked the switch somewhat. So there's now more investment going out of the country than coming in. That's why that net foreign direct investment chart is negative. When you add in all the uncertainty and the costs of tariffs, well, that's set to make those net investment flows even more negative. We've spoken about a little bit already. There's lots of different channels of impacts of tariffs on China's economy. Because of that, industries in China are also set to feel the impacts of tariffs differently. This chart tries to show that. It shows the hit to industry output across this year and next. It compares our latest forecast with our pre-election forecast, and that shaded bar in the middle, that's the GDP deviation that I've been speaking to. So anything above that line, or that shaded bar, that shows an industry facing an outsized hit because of tariffs. Anything below that, that shows the exact opposite, an industry that is a little bit more insulated from some of the potential pain that we're expecting. It's worth saying first up, no industry is immune to these falls. In fact, every industry in China is going to be worse off because of these tariffs. But pain will be sharpest in a handful of industries, particularly those export-oriented firms. So those directly impacted by tariffs, like manufacturers and miners, as well as those indirectly hit through things like weaker trade, and that's predominantly targeted things like transport and logistic firms. Just quickly, real estate also will face more pain than the average industry. That's because of all the chaos that tariffs and weaker growth will cause. That'll hinder the sector's already pretty shaky outlook. Real estate has been struggling for a long time in China. Add in a shock like that, and it will delay its recovery even further. Now, as we said, governments will certainly step in here to offer some support. There's a bit of a timeline of the support that's already been announced. I won't go into all the detail of that, but you will get a copy of these slides, and that will show all the announcements that have been made. I think just really quickly, it is worthwhile discussing how the expected supports this year will look. Part of it, it'll read from the usual playbook of China stimulus, big infrastructure spending, industrial support for manufacturers and exporters. But we'll also see something a little bit different this time. In a bit of a break from history, we'll see more support for households. So at the Central Economic Work Conference back in December, it was announced that supporting consumption would be the #1 priority this year. And we've seen a number of policies already announced to try to make that a reality. So expansion of trading schemes to encourage households to bring forward purchases. We've also seen local governments or a number of local governments hand out spending vouchers, consumption vouchers, again, trying to support spending. The central government is lifting government wages, and there's also foreshadowed an increase in the pension. Question is why? Why are officials now looking to support household consumption after a long time of prioritising building and exports as growth drivers? Really, it's two reasons. First, China has built massively over the last decade or so. That means there aren't too many productive assets left to build, or at least any that would give a sensible return on investment. And the second is the most obvious reason, and that's that tariffs constrain China's ability to sell to the world or to use global demand as a growth driver. That means China needs to find new drivers of growth outside of infrastructure, outside of exports, and with a bit of support, policymakers are certainly hopeful that households can provide that. But I'll pause back here and hand over to Stefan.
Cheers. Thank you, Harry. Yeah, why don't we move on and talk about Japan and developed Asia more broadly? So I'll focus here on Japan, South Korea, Taiwan, because they share some broad similarities. To give you the upshot right at the top, we think the increase in tariffs that these three economies are going to see is going to be a little bit smaller than those other economies across the world are going to see, but they're not going to come away unscathed. So one reason for that is what you're seeing in this slide here. All three economies that we're talking about here, Japan, Korea, Taiwan, right? They run large export surpluses vis-a-vis the US. In Japan's case, it's around 70 billion. In Korea's and Taiwan's case, it's around 50 billion or so. So if you tally them up, that's quite a sizable chunk of the US's trade deficit. It's maybe 3/4 or thereabouts of the surplus that the European Union runs, which tells you that these countries are going to be in the crosshairs. Specifically, the new president in the US, Donald Trump, has mentioned he singled out cars several times on the campaign trail, and as you can see in this chart here, car exports are quite significant in the case of Japan and South Korea. They show up as the yellow bars here, so they explain quite a sizable chunk of the export surplus that they run vis-a-vis the US. But there are reasons to expect that the tariffs are not going to go up quite as much as at other places. And one of those reasons is shown on the next slide here, which looks at outward FDI from Japan in blue, South Korea in green, and Taiwan in pink. All three of these economies are large international investors, and much of that investment is going to the US. In fact, depending on how you measure it, Japan is the largest global investor within the US. So that's, for example, by inward FDI stock in the US. There's lots of complicated reasons for that, but one of that is history. So there was a period back in the 1980s and 1990s when US-Japan trade relations weren't looking so good. We tend to think that trade friction is more of a modern phenomenon, but there used to be periods in the past where that was the case as well. And back then, Japanese firms used FDI in the US to avoid threatened trade restrictions. So they set up manufacturing plants in the US that contributed to local production and GDP and created jobs on the ground, which then reduced political pressure for tariff or quotas, which were discussed at the time. So this may serve as a blueprint for managing tomorrow's trade frictions. We're already seeing higher investment, for example, from various electronics producers in the US. So Korean and Taiwanese producers in particular. Another factor, which is not shown here, but Steve mentioned it at the top, is politics. Despite the heated rhetoric on trade, advanced Northeast Asian economies are all major allies of the US. So they have formal treaties or implicit guarantees that mean there's a security umbrella that covers all of them. So there's a scenario where the US might ask them to step up defense spending in return for lower tariffs. Regardless of what sort of tariffs we're actually going to see, we don't expect there to be significant retaliation from either Japan or Korea or Taiwan because of those very strong economic and security ties. So what does all of that mean for growth? If we move on to the next slide, we have a few charts that plot the impact on GDP in Japan, Korea, and Taiwan. What you see here is that growth declines in 2025 and 2026, followed by a lackluster and incomplete recovery in the years after. The reasons for that are straightforward, right? Tariffs are going to go up. They don't go up as much as in other places, but they go up, and that's negative for exports. Also, we expect slower growth in the US and China. So even in a scenario where Japan, Korea, Taiwan would not get their own tariffs, the growth would slow regardless because the US and China are their largest trading partners. So when growth in those two economies is slow, that always weighs on exports. Weaker exports means weaker GDP growth. The damage is relatively more modest in Japan because the share of trade to GDP is lower. Damage is relatively larger in Taiwan because it is a more trade-open economy, as Katrina mentioned at the top. Let's move on and maybe have a quick look at how this breaks down across expenditure components. I won't spend a lot of detail on this here because the logic is pretty similar to what Harry laid out for China. A lot of the impact is going to be on obviously exports and then investment because everything that we expect to happen will bruise business confidence. So the mechanics are quite similar. I should maybe also mention that we expect the policies that are being adopted in the US right now to lead to further dollar strength in the near term, which is again one of the reasons why the net impact on trade that Harry laid out at the top is pretty mild. If the dollar appreciates, that offsets some of the increase in tariffs. Vice versa, you get the exports from Japan, Korea, Taiwan, China as well. They perform a little better than they otherwise would. So what you're seeing is going to be a global reduction in trade across the board. So the individual country balances are not going to move all that much. Let's maybe move on to the final slide. And again, I'll keep this very brief because there's really not much to see here. We don't think inflation is going to pick up very much in Japan, Korea, Taiwan. There's got to be a little bit of inflation more inflation in the US, obviously, because of tariffs, and also in China because of retaliation. And some of that will bleed into consumer prices elsewhere. But the pass-through from import prices to domestic consumer prices really isn't very strong in any of these economies here. So we don't really see a significant pickup in inflation. Maybe though, finally, to the point Katrina raised at the top, the fact that we expect currencies to depreciate. So the Japanese yen, the Korean won, the new Taiwan dollar, they would depreciate. That might lead to monetary policy change. And indeed, it's one of the reasons why we think the BOJ will bring forward some of its interest rate hikes. So our forecast is for the BOJ to raise its policy rate at the end of this week. And the weak yen is a key reason. The Japanese domestic economy is not doing well, so that's certainly not the reason why the BOJ is hiking. The BOJ is hiking because the yen is weak, and it's quite oversold if you look at monetary policy differences or economic fundamentals. So as Katrina noted, right, they're going to try and stem some of that weakness by raising interest rates. Let me hand back over to Katrina to give us the overview for India.
Great. All right. Thanks so much. So in the 6 or so minutes, I can't do India justice, but if anyone is interested in more detailed analysis for India, please do reach out because we have some really nice research that's done by some of our economists here, and we can provide you much more detail. But I think the interesting point that I will raise when it comes to India is, when we look at how economies across Asia will be influenced by a Trump presidency, tariffs are assumed to be the largest direct impact. And then perhaps the secondary impact is around just what Stefan was talking about around, currency, inflation, monetary policy implications. But for India, that tariff impact isn't really there so much. I mean, India is a relatively closed economy. Domestic demand is the more important driver of overall economic performance. And so our India forecast hasn't meaningfully changed with a Trump presidency. And that was actually one of the questions in the chat. I mean, India's GDP for this year is about 6.4%. And that's coming off the back of some more assumed weakness in domestic demand rather than so much of a more challenging export environment. And that's coming off the back of a 6.8% expansion last year. But one point I will mention, and if we go on to the next chart, a really interesting development is around immigration. Now, immigration could be a pressure point for India, and we've seen that it has been an initial focus for Trump with eyes on Mexico and Canada. Now, migrants from India make up the largest share of overseas arrivals applying for employer-sponsored temporary work visas for high-skilled workers in the US. Now, in the campaign trail, Trump labeled this visa program as unfair for US workers, and so we could see some significant cuts there. Now, the importance of this visa program is reflected in the fact that around 80% of adult Indian immigrants in the US had tertiary qualifications. So if this program is meaningfully impacted, we would see that important labor supply in the US of Indian immigrants be affected. Now, if we flip that to what that means for India's economy, it impacts from a consumption point of view. With Indians working overseas, that important input into local consumption patterns comes via remittances as well. So that's something to just keep in mind here. Now, just the final slide I'll quickly show is geopolitics. Now, India's relationship with the West, particularly the US, came under pressure in recent years because we did see that Modi didn't participate in sanctions against Russia. Rather, India actually expanded its trade with Russia, including, which you can see on this chart, by imports of Russian oil. Now, given Trump's less aggressive stance on Russia, this new Trump administration really does offer India an opportunity to reset its relations with the US, and India has also positioned itself as a counterforce in some degree to China when it comes to the US. So there is some opportunities for India here to kind of repair its ties with the US.